I want to build an effective and profitable day trading Forex breakout strategy. The concept behind it is simple. Markets never move in a straight line. They consolidate, build ranges, and eventually price breaks out of that structure and expands into a directional and explosive move. My idea is very straightforward. If you can identify these ranges early enough, you can take advantage of the expansion phase and avoid getting trapped in the noise when false breakouts do happen. And they do happen. I'm going to define exactly what a range is, how we identify it, and how we can turn this idea into a structured trading strategy that can be tested and optimized properly. I'll start by building a clean strategy blueprint/structure, define proper parameter spaces for optimizations, and set up the full optimization process to see if there is an actual edge in the breakout behavior. So on every market you get these periods where price moves sideways. It consolidates, slows down, and effectively forms a range. This is the consolidation phase. During this phase, the market is balancing between buyers and sellers and there is no clear direction, but there is an accumulation of orders on both sides. Eventually, price shifts and starts expanding. It breaks out of the range with a lot of momentum and we get an impulsive move in one direction. Having said this, not every breakout develops like this. In fact, most breakouts move out of the range and then come back and continue trading inside that range for the remainder of the day. This is what creates most of the losses on the most known breakout strategies. And the cause is timing and context. An effective breakout strategy cannot just focus on detecting the range and the breakout level. It also needs to take into account the timing and volatility of the market. If we look at it closer, these ranges don't form randomly throughout the day. They tend to cluster around specific times of the day. In Forex especially, liquidity and volatility are heavily session driven. And what you often see is that market consolidates during a specific window, like you see here, builds a range during that period and then explodes after the compression phase ends. This is basically how most moves in the market do happen. They just consolidate, then have an explosive move, consolidate again, explosiveness, consolidate again, explosiveness, and so on and so on. This is obviously not 100% of the time, but it does happen a lot. Each instrument has its own behavior, hence its own timing. So instead of treating breakouts as a single universal rule, we are going to design the system around two core ideas. Ranges form in repeatable time windows, and breakout quality is strongly dependent of when the breakout actually happens. Now let's get to properly building the strategy. So we are here in the strategy builder. I'm going to name this range breakout strategy, and let's get to building. I need a clean breakout blueprint that we can test and optimize properly. Let's start with the entry logic. I'm going to use a simple range breakout model. The first input is the range length, so how many candles are used to define the consolidation zone. So essentially, you look back a certain number of candles, identify the high and low of that window, and that becomes our breakout range. Then I'll define the second parameter, the breakout window. This sets how many candles after the range is drawn where a breakout is considered valid. So the market has to break out within this specific time window after consolidation forms. Now, for the exit components, I'm going to use a time-based exit. And what this basically does is once a trade is open, it will be closed after a fixed number of hours if it didn't reach neither the stop loss or the take profit levels yet. The only input we are going to mess around with is how many hours after the entry before we close the trade. So every trade has a fixed lifespan. And I'm not going to optimize the minutes because that's a lot of granularity that I just don't need. The stop loss is going to be placed on the opposite side of the range. If a long breakout happens, the stop goes at the range low. If a short breakout happens, stop goes at the range high. This keeps it consistent with the actual market structure that we're trading. For the take profit, we are going to set a risk to reward ratio of 1:2. If a strategy has an actual edge, it should be stable across reasonable risk-to-reward variations, so we don't need to optimize this. 1:2 gives us a good balance between a realistic win rate and winners that still outperform losers by a good mile. Now we can add constraints or filters in order to control the strategy behavior. The first filter that I'm going to choose is the max trades per day. And I'm going to set this at a 1 trade per day because I don't want multiple overlapping signals or overtrading. We want the best single opportunity per day. The second filter will be the session filter. And what this does is it only allows trades during specific market sessions, like I said previously. And this becomes an optimization parameter as well. Different instruments behave differently, so some break during the London session, some during the New York, some during overlaps, and so we need to also optimize this per instrument. Finally, we intentionally keep trade management extremely simple, so I will not have any break-even rules, any partial take profits, no trailing stop losses. The goal is just simply building a clean baseline that we can actually evaluate properly. Every extra layer we add now only makes the results harder to interpret, so let's just focus on the basics and improve on later iterations of this strategy. Now, the next step is where things actually get interesting. I'm going to define exactly what we need to optimize and what we intentionally do not want to optimize. So let's just select the optimization setup, and first I'm going to start with only the major pairs. I want clean, liquid and stable data before I expand the testing to all the other instruments and other markets that exist. So if we can find an edge here, then we can later scale this into gold, indices, crypto and other Forex pairs. For the optimization period, we're using a date range from 2013 to 2026. This gives us basically a full multi-cycle dataset, different volatility, macro environments and different liquidity conditions. We're not overfitting to a single market phase or just using not enough market data to actually test this properly. I'm also going to split the optimization into a 70-30 in sample out of sample split. And I'm going to select top end configs to 10, so we will only calculate the full metrics on the top 10 runs of the in-sample profit factor. Quickly, the difference between in-sample and out-of-sample is that in-sample is where we build and optimize the strategy, and the out-of-sample period is where we test, and if it actually generalizes to unseen data, we do not optimize again here, and we only confirm that the strategy still works on unseen historical data. So if something only works in sample, it's probably overfitted. We only care about strategies that survive both and where their metrics are actually pretty similar between the in-sample and out-of-sample periods. Now, instead of a full grid search, I'm going to use a 3-step optimization process. Grid search would be very overkill here because the strategy is intentionally simple and it does not have a lot of parameter combinations. So the process works like this. Step 1 is a broad scan. We test a wide range of general parameter combinations and identify the most promising regions of the inputs. On step 2, we refine and we take the best performers from step 1 and narrow the parameter space. On the confirmation step, so step 3, we validate that the best configurations still perform consistently and then actually run the full evaluation only on these refined candidates. Basically, instead of brute forcing everything, we progressively narrow the search space. Now, to prevent low quality results, I'm adding an early filtering condition. The key constraint here is a minimum of 100 trades per year, so this ensures the strategy is actually active, and since this is supposed to be a day trading strategy, it actually needs to place a lot of trades during the week. This scales down to an average of 2 trades per week in average. Now we need to actually define what gets optimized. So we are optimizing the range length, and I'm going to set the start, stop and the step. I'm going to set the range candles to start at 1, go all the way until 20 and go in steps of 1. For the breakout window, we will also optimize from 1 to 20 in steps of 1. The active trading sessions, we will optimize all of them, and the time-based exit duration. Like I said, we will only optimize the hours, not the minutes. That's too much granularity that we don't need to this strategy, so let's just keep this at 1 and let's give it a full day before we need to close the trade manually. So let's start at 1 to 23 hours in steps of 1 hour. Essentially, we are testing how long the consolidation period should be, how long after the consolidation period we allow breakouts to happen, when during the day should the strategy actually be active, and how long the trades should be held before it hits the stop loss or take profit levels. And just as important, I'm locking in certain things like the trades per day. We will keep this at a fixed 1 trade per day, and the take profit at a fixed 1 to 2 risk to reward ratio. We are not touching this because they define the core structure of the system, and optimizing them will just add noise rather than any insight at all. So now that the system is fully built and the optimization space is well defined, we are going to run it. So I'm going to run the 6 optimizations, 1 per each instrument. Okay, so in the next video, we will go through the results. I need to let the optimization actually finish, and we'll see what actually survives out of sample, and most importantly, find out whether this type of breakout trading strategies actually hold up under proper testing.